Tom Lee, one of the best analysts in the business, just did something insane. Number one, he went on CNBC and called bottom for the stock market this week. He then went ahead and published this article on his website saying the best 10 days are probably coming this week. A lot of bullishness coming out of Tom Lee. We got to talk about it a lot too. Cover first of all, let's start with the CNBC interview. I'm going to play with the clip.
Everybody thinks the market's headed lower.
Yes, but instead we could be bottoming, maybe this week.
Now, he didn't commit to it, but he's saying, if the stars line, we have a chance of getting a bottom this week. Now he talks about the fact that he doesn't believe Donald Trump is going to get the economy to stall speed, and he's about to roll back some of this tariff talk. He's also talking about the Fed getting off the hockey stance and more to a D stance, actually accelerating the interest rate cuts a lot faster than people think. And he's also talking about the indicators. As far as crowd psychology, he's seeing from the market, seeing a day like Friday, where you had bad news, but the market was going up, in a day like yesterday, where the market went up for no reason. Then do for no reason, this insanity is basically a signal for him for a bottom. Now I'll also show you this article on the screen right now. This article was posted on FS Insight, a best 10 days, probably coming this week. Now, Tom Lee went ahead and published this article on his own website, and I'm also going to give you the highlights from that. He's basically talking about the fact that probably this week we're going to see turn around the market going against the narrative against grain. Most people are seeing a lot more bearishness from this market. A lot of experts are saying we're headed downstairs for a lot lower. Tommy saying, hey, this is the reversal now. Whether he's right or wrong, I want you to listen to his theory in this article. He's also talking about the fact that it is really a bad idea and an unrewarding exercise to try and get out during a pullback, because some of the best days of the stock market historically came during a bad time when you had a lot of bad days. Sometimes 1 or 2 days in between could be one of the greatest days of the year. They don't always come during a bull market. And he also showed in this specific article something I've been saying for months, if not for years, which is if you miss the best 10 days, you're going to diminish your returns insanely. Now, I always talk about the fact that over the past 20 years, if you miss the top 10 days, well, that means you diminish your returns by 50%. Tom Lewis, he usually does, went ahead deeper into data and went all the way back to 1928. And he basically said from 1928 until now, if you miss the top 10 days, you have diminished your annual average returns from +8 to -33. That is insane. Now, he also went ahead and tested 2015 to now, which is a 10-year period, lowering your returns from +12 to -10. So he's basically saying, look, folks, even if you want to time the market, even if you think you can, if you happen to make a little mistake and you'll miss the top 10 days, you're going to kill the entire upside of staying in the market. He basically says that the market moves mostly on those 10 days. Those peak 10 days are the ones that actually moving the market, not the rest of the time. Now, if you look at the past 2 years, it's also a data point he tested and said, look, over the past 2 years, we had an incredibly bullish market with did 60%, 30% in 2023, 30% in 2024. But if you miss the top 10 days in these 2 years, your returns are going to be 4% per year instead of 30% per year. Again, this is insane data. He's basically saying, hey, do not time the market. It is a futile thing to do, even if you think it's coming down lower, even if you think it's going to go up and it's going to reverse. It doesn't matter. Timing the market is a bad idea. It's not me saying it. It's not Tom Lee saying it. It literally is the data saying it. And he actually explains in this article why he thinks the reversal is a lot closer than people think about it this way. Whenever we had a big crash in the stock market, right, nobody has ever expected it. Whenever we have a reversal, nobody expected it as well. In 2023, nobody thought the market is going to go crazy. In 2022, nobody thought the market is going to crash and correct These things happened out of the blue. They by definition happen against the general consensus, against the general narrative. So when somebody expects something in the stock market usually doesn't play like this, now he's saying, look, if I look across the board and I'm seeing extreme fear on the fear and greed index, I'm seeing panic hitting peak levels, and we have a lot of the worst probably behind us, because by the time everybody's panicking, it usually means that the bad times have ran there. Of course, he also talks about the fact that Trump is eventually starting to roll back some of that tariff talk he uses. That is a flamboyant way to get attention. He's an agent of chaos. He likes to throw his weight around, but does he want to bring the economy to stall speed? Tom Lee says that he doesn't think so, and I've said it before in my videos. A lot of these analysts there saying, look, folks, Trump, you may like him, you may dislike him, it's not a political question. And a lot of these analysts, they believe he's going to bend and bend and bend, but he's not going to break, because it is irrational and illogical. And they believe that despite his flaws and issues they may have with Donald Trump, right, his Iraq rational player, and a rational player is not going to break the stock market and the economy just to throw his weight around. Now, whether he's right or wrong, only Donald Trump knows. And we're about to find out. He also says that if this continues, we'll probably have a weaker jobs report, a weaker macro data. That means that the Fed will have to accelerate the rate cuts that they plan to later this year, and that's going to push the stock market a lot higher. Now, this is an interesting thesis. Now, if Tom Lee is right about this, good, we just keep on DCA, keep on chugging along into the afterlife, no problem, nothing changes. But Tom, what if this guy is wrong? What if Tom Lee is absolutely wrong about this and we're headed to a major correction? What if this isn't the bottom? Well, that's great news. Tom, have you lost your mind? No, let me explain. That is great news, because as I've been explaining to you for years and years and years, waiting for this moment, I told you the real money in the stock market is not made in bull markets. It is made in bear markets. It is made in corrections. It is made in crashes. The millions, the real generational money is made when the market corrects, just like we've done in 2022. Yeah, the last few years, they were great. But if you haven't been buying Penner at 6 and at 10 and at 12 and at 15, you've only started buying at 70. Well, you're up 10%, 15%. We're up all the way from $66. The same thing is happening again. We've been praying for this. We've been saying we need a dip, we need a correction, we need the weak hands to leave, the traders to leave, so we can get some discounts. The real money is made when the market crashes. And guess what most people don't understand, because of their goldfish memory, is that these crashes are a lot shorter than it feels like. If you're sitting with a nice girl and you having a nice chat, and a girl that you particularly like, well, 5 hours can feel like 10 minutes. But if you're in the dentist, half an hour can feel like 5 hours. Think about it. Whenever we are waiting in line, it feels like eternity, even though it might be objectively 10, 15 minutes, but it feels like forever, because that's relative. The same thing with the stock market. When the bear market hits, people feel like it's a lot longer than it really is. And if you look at the data, the average bear market in America lasts 10 months. They rarely go beyond 2.5, 3 years, while the bull markets last on average 5 years, and they usually go from 5 to 10 years. So if we're playing the odds game, if we understand that one is average 10 months, the other one is average 5 years, and if this is a roulette table, where would you put your money? On something that lasts 10 months, on something that lasts 5 years. You have to play the odds. A bull market is a lot more common, and even if you look at the past 25 years, we had 4 major corrections in the stock market for 2020, 2022, 2008, 2000. Not that particular order, but they were significant, and yet the stock market in that time gave you 500%. Look, it's very simple. You have to be in the market in order not to miss the best 10 days. Look at what happened in the COVID crash. The crash happened. A lot of people panicked. The stock Market drops all the way to 2,300. The S&P 500 drops to 2,305. Years later, we're up 200% with if 40% a year on average if you left. Because you panked during the co-insanity. Freak out, you've missed on one of the greatest bull runs in history, and yes, the markets are a little bit shaky right now, but that's because the markets hate uncertainty, hate risk. Whenever Trump starts talking about tariffs, nobody really cares what the end result is going to be like. Nobody cares that Trump is most likely not going to pull the trigger, that the final result is not going to be as bad. Nobody cares. The end result is not relevant. What's relevant is the risk and the potential of really, really bad things that has to be priced into the market. And that's what we have right now, a knee-jerk reaction to stuff Donald Trump said, nothing concrete. Yet no policies have been truly established as long-term. Nobody really knows what's going to happen, and that uncertainty leads to a lot of pricing pressure, and I understand that people freak out. I understand a lot of you have joined the stock market recently, but those of you who are new, you have to understand this isn't something that's new to us. By the way, February, March, 2 of the weakest months in the stock market seasonally, so this is nothing special. We've also seen the market pull back and correct all the time. If you zoom out, you're going to see a lot of corrections, even though the line keeps going up. We have 5% corrections 3 times a year. This is nothing. When we have a crash that is driven by nothing, that has to do with the companies you invested in. It's not like if you bought Nvidia stock, Nvidia is no longer a good company. It's not like if you bought Tesla stock, Tesla somehow have lost its dominance in the EV market. It's not that Penner just lost its government contracts. Like if something happens that is company specific that crashes the stock of a company regardless of the market, that's a whole different anatomy, my friends. But that's not the case here. When you have a macro-driven correction or a macro-driven stock market crash, where all stocks in them are falling because of something that has nothing to do with the companies, it's some sort of an overall macroeconomic reason, right? When that happens, history teaches us one important lesson, that is long-term buying a port. As long as you do it slow, a lot of people misunderstand what I'm saying, and they're going to lump some into the stock market thinking, oh my God, yeah, Tom said it's a buying opportunity. We don't know where the floor is, Tom Lee says this week. It might be next year. Who knows? You don't know where the floor is. So what you do is you slowly dollar cost average down. You don't go lump sum and betting on this is being the bottom, right? You slowly dollar across average as it drops. And that way you get to not time the market even once. Now, if you do it slow, you understand one thing, you're going to be riding the market cycle. The market cycle repeats itself like clockwork. This is literally like a time machine. The market cycle is undefeated. It's always the same: doubt, then hype, then crash, then doubt, then hype, and the crash. It will repeat itself endless amounts of time. Like Neo in the Matrix, it's been going on forever. If you know this, you understand this principle. All you have to do is buy it all time and double down on the way down, and that way, eventually, you get to buy Paler at 6, at 10, at 15, at 20, and let the market do its thing, and it crashes again, but say 60, 70, 50. Whatever it's going to land at, you do it all over again, but the bottom point is always going to be higher and higher and higher as long as the company is actually a solid company, which in the case of Paler and Tesla and Nvidia and all these great companies that are being sold at a discount right now is indeed the case. So all you got to do is relax. Understand that DCA is the right way. Dollar cost average is the right way. Understand that the biggest challenge of investing, especially in volatile, turbulent times, is the psychology. What beats investors is this, not the mathematics, not the models, not nothing. This is where you lose if you get emotional, if you panic, if you start doubting yourself, if you haven't done the research, if you don't understand why you bought certain stocks, if you don't know why you invested in Paler and Tesla, then it's very easy to panic But if you've done the work, you've done the research yourself, and you have a strong conviction, and you understand the quality of the businesses you invested in, and you understand the patterns of the S&P 500, this is a very good time for you. You're enjoying this. You're saying, oh my God, this is beautiful. We're going to get to replay 2022 again. Maybe it takes a year, maybe 2 years, maybe 10 months, maybe it's 5 months. I don't know, but we're going to get a lot of discounts. And then over the next 5 years, we're just going to write it up. Well, all of these other yahoos are going to be bailing the ship. That's fine. The traders are going to be leaving. That's fine. We're going to make that generational gap. It's not as easy as it sounds. A lot of people struggle with that psychology.